Hello and welcome to CMC Markets on Thursday the 1st of August and to my weekly catch-up with our sales trading desk. Joining me this week is my colleague Toby Morris, and it's been a fairly busy week for earnings. An extremely busy week, specifically in the technology sector. We've seen the S&P just hit new all-time highs above the 1700 level. We can see that on our chart here behind me. And I think that was largely as a result of a very good ISM number that we saw about 25-30 minutes ago, 55.4, a bit of a surprise to me. We saw yesterday US GDP beat expectations, ADP jobs report comes in around about 200,000. I think it's raising expectations of a taper, isn't it, in September? I'm still sceptical about that. What do our clients think?
Well, they're certainly not getting too much of a guidance from anyone. We've had all the central bankers come out and say pretty much as little as they possibly can do recently. Bernanke's no real exception. They're not really giving anything away.
There still remains a concern about, I think, the manufacturing sector, but that ISM number sort of flies in the face of all the Philly Fed, the New York Empire manufacturing, which were both disappointing, and yet jobs growth continues to head in the right direction tomorrow. We've got non-farm payrolls. Yeah. Obviously, there's a webinar that we are hosting, so hopefully watch out for that. We'll stick the link on the bottom of the video once we've done it. There's a couple of stocks that you really want to focus on, isn't there, Toby? So talk us through them.
Just a couple that have, always pretty big stocks with our clients. Facebook and Apple, big tech stocks. Stocks that in the past have seen a lot of two-way flow as well. For equities, they see quite a lot of two-way business given the news flow that we've had over the last sort of 12 months.
Look at that two-week performance.
Well, there you go. And more importantly for clients, 72% long on a stock that I say, historically has seen a lot more two-way flow. Hit its IPO price, smashed expectations. I think the worries that people, certainly a few clients I've spoken to that are into the stock, the worries that people had over Zuckerberg and whether or not he was going to favour the users over shareholders has not really borne through.
A year ago, everyone was sort of expressing concern about how they were going to monetize, the mobile app. And given the fact that we've jumped this, to this much in the space of 2 weeks, do you think that maybe there's a bit of bandwagon jumping going on here? Because I think there was a concern that the price was overvalued at the IPO price. Are investors now saying that it's not?
But they've had, you've had a year to kind of think about it a little bit more. The worry was always advertising revenues. That's obviously going to be the driver of their revenue. They're still going to be under massive pressure every time they report for their revenues. They're always going to be constantly trying to keep up. But the big thing was that he was the one that pushed the mobile apps more than anyone else, and it's really borne through. They've had some really cracking figures from it.
Yeah, absolutely. Well, that's sort of the technology space. We've seen the Nasdaq hit 13-year highs. The S&P 500 is at all-time highs. Let's have another look at one of our favourites, Apple.
Yeah, up nearly 8% in the last 2 weeks. Probably more astonishing on this one, 95% long. Again, it's another one that's seen a lot of two-way flow in the last sort of 12 months or so.
Yeah, 95% long.
So I think it's a similar story with top clients as well. But they've beat expectations. But I think for the first time we've kind of seen more realistic expectations from the marketplace. So everyone always expects Apple to have this massive beat. They've always set their targets quite low and come in with massive beats. And I think this was the first time that people weren't really expecting that much. And it was a nice surprise to investors that they were helped by some strong iPhone sales, but I suppose the worrying thing is it looks like a lot of them are still from the 4 rather than the 5. They still haven't come up with that lower handset alternative. And
they haven't cracked China yet, have they?
Well, because of the lack of anything for the emerging markets in terms of a lower price handset.
Well, that's the thing. I think $600 for a new iPhone, without a contract. That's essentially it's without a contract. That's an awful lot of money when you can buy an iPad for the same amount of money. Yeah. Obviously straight off the shelf with a 3G contract. So, I think, you're paying a premium for getting an iPhone when you could actually get an iPad with more functionality. And okay, yeah, you can argue about the connectivity of an iPad, but I'll tell you what, I prefer one of these to an iPhone every day of the week and twice on a Sunday. Looking at that, we could well be gearing up for a bit of a breakout. We've held the 200-week moving average. We can see it on the bottom of the chart there. Key resistance at 459, 460. I think there's potential for a double bottom there. So keep an eye on that over the coming weeks and months. The investors, our clients, are the right side of it.
Yep.
I think what they're doing is they're hedging it with the S&P, because the S&Ps are once again at all-time highs, yet our clients are sort of more short than long, I think.
Yes,
about 70-30.
I think it is. I think it's about 70-30. There's a real split between a lot of the indices at the moment. The only real one that stands out really are a couple of the outlying or the peripheral Eurozones. So Spain and Italy, clients have been the right side of over the last couple of weeks, because they've massively outperformed in the last few weeks.
What do you mean they're long?
Yes, exactly, sorry.
No, I mean, that makes perfect sense. All equity markets are up over the past few weeks, and I think it's largely on the basis that central banks are going to remain in accommodative mode. We've seen PMIs out this morning. They're broadly in line to slightly better than expected. There are a couple of exceptions on the...
Spain and France.
Yeah, Spain and France were slightly disappointing, still below 50. UK PMI though, I mean, that's a significant beat, isn't it? 54.8. And let's talk about Lloyd's, because there's talk about that being spun off back into the private sector. The performance there, we're almost back at break-even levels on that particular stock, aren't we?
I think it's 60. It's not exactly clear. It depends on where you look. I think about 61p
or 73p if you. Yeah, I think
depending on what you factor in, I think it comes out a different number.
I think it's 73p. I prefer to take the higher number, because I think governments like to fiddle the numbers to suit their requirements. Big resistance though on that chart, the 2010 highs, just below 80 pence. So I think we're going to start to run into resistance at those sort of levels. And we've returned to profit for the first time in 3 years.
Yeah, citing slightly better margins. They've certainly been of the banking stocks that everyone was looking at, has looked at ever since the crisis. You know, the RBS, Barclays, Lloyds, they tended to get grouped all together, and certainly over the last 12 months they've massively outperformed the others. I
certainly think that they're starting to outperform relative to Barclays, which has obviously slipped back on the back of the rights issue that they announced earlier this week, and RBS is due to announce tomorrow morning, Friday morning, and hoping for a return to profit. I'm not overly optimistic. I think there's far too much government interference there. So keep an eye on RBS. Going back to currencies, it's a little bit boring, really, isn't it? When you look at currencies, we're sort of in a range, euro-dollar cable. What are clients sort of looking at with respect to currencies? Have they got a particular bias, longer dollars, longer euros, longer sterling? Or is it just range trading?
Yeah, like you say, it's playing the technical levels around, trying to guess what the different central banks are going to do, and like we said before, they're not really giving a lot away. I suppose probably the biggest one, we've got 75% long on dollar yen at the moment. Euro dollar 73% short. There's no real massive bias to any of the major pairs at the moment, and I think that's reflective of the wider market as well.
I think one of the interesting things, let's look at this euro dollar chart here. This is today's daily candle chart, and we do have the makings of a potential bearish engulfing pattern on the daily. Now, if that closes in New York tonight at that current level, then that does potentially open up a move back to the range lows around about 130 and the 127.50 area. So keep an eye on that. We need to stay below the highs of this week, which were around about 133.40 on Wednesday. Okay. All right. Well, I think that's pretty much it for this week, unless you've got anything you want to add, Toby. Otherwise, I'll wind this up, and please join me for the non-farm payrolls webinar tomorrow afternoon at 1:15, lasts till 1:45, and we can have a look at what to expect and the likely reaction in the markets thereof. Okay, thanks very much. Thanks for Toby. Until next week, this is Michael Hewson and Toby Morris from CMC Markets.